Bloomberg Audio Studios. Podcasts, radio, news.
As the war in Iran continues, global economies are bracing for the economic fallout.
The United States and its partners have launched Operation Epic Fury, one of the largest, most complex, most overwhelming military offensives the world has ever seen. Nobody's seen anything like it.
With oil and gas prices rising sharply, African countries could be among those facing an inflation shock.
You have a major LNG facility in Qatar closed, the largest in Qatar. You have, of course, that refinery in Saudi Arabia, at least closed temporarily. The inflation question and the inflation shock is now being priced into these markets.
If it becomes prolonged, then all bets are off the table.
On today's podcast, we'll look at what the conflict is doing to energy prices and supply, and what the hit could be for African economies. I'm Jennifer Zabasajja, and this is the Next Africa podcast, bringing you one story each week from the continent, driving the future of global growth with the context only Bloomberg can provide. Joining me today is Bloomberg's Asia energy reporter, Stapczynski, and also Bloomberg Economics Africa economist, Yvonne Mhango. Thank you both so much for joining me. I know it's been quite a busy week for the whole newsroom, but especially the two of you, so appreciate your time. Stephen, let's just start with you because you look very closely at the dynamics in the energy sector. Give us a picture of what we had been seeing with oil prices in the last few weeks in the lead up to the eventual escalation that we saw in the Middle East last weekend.
I think the oil market over the last few weeks before this weekend was expecting something. You know, when you talk to the traders, they were talking about the buildup of the military force, right? The largest U.S. military force in the Middle East in decades. They were looking at the rhetoric. They were looking at the negotiations happening and the failure to make a deal multiple times. So I think the oil market, when you look at the prices, oil prices kind of continuously rose from late December into January and into February. We're slowly kind of stepping up higher and higher with this anticipation that if a deal wasn't done every time they went to the negotiating table, then maybe you could see some sort of strike on Iran. And no one knew exactly the level of the strike. But especially, I think, when the State of the Union happened and Trump said that he would never allow Iran to have nuclear weapons, people in the market talked to me and they said that's when they really saw, okay, maybe something would be happening. It was, of course, a lot of guesswork. But in the end, the market did continue to rise ahead of all of that.
Where have we seen the prices really rising substantially? Because I feel like for a while we had been talking about incremental rises, right? A bit range bound in terms of Brent crude. But where have you seen the most substantial rises in prices in the energy market that we should be focused on?
There are a number of different places, right? Brent is a global benchmark. Its trade has, very liquid. It can be sometimes quite volatile, but you're right. The prices haven't been out of sight increases. You've seen incremental increases of 7, 4. Today it's up 2.8%. There are other markets that are a bit more crazy. Jet fuel prices in Singapore have really surged to the highest level in years. You're also looking at different types of prices for the ships themselves. To rent a ship, the prices are rising to the highest level in years. And then also look at natural gas. Liquefied natural gas prices have surged quite significantly, about more than 50% over the last 3 days. And that's the European benchmark and the Asian benchmark. And that increase is quite interesting because unlike the oil market, which I think was anticipating some sort of strike for Iran, had not actually been increasing. The gas market, I think, interestingly enough, had somewhat discounted that something would happen and wasn't expecting some sort of large impact that we're seeing today with the Strait of Hormuz getting shut and the closure of Qatar's largest liquefied natural gas export facility. So all of that together has made gas one of the more interesting parts of the market.
You talk about the Strait of Hormuz, Stephen. Is that the route that the energy market is most fixated on in terms of the risk to prices going higher? What are the other routes potentially that we should be focused on?
I think the oil market and gas market too are focused on two things. One, Strait of Hormuz, like you said, it's a key conduit for a fifth of both oil and gas seaborne supply, but also the region, right? So what's been very different about this strike and this conflict versus previous ones is that it isn't just a tit for tat sort of thing between Iran and Israel. This is spreading to the wider region, and Iran is hitting countries that many thought were their, sort of their allies or their friends in the region. I'm talking Qatar, UAE, and also Saudi Arabia. They're antagonizing their neighbors. So the market is looking at, okay, if there are some drone strikes on Saudi Aramco's largest refinery, what is the impact there? They've shut it down. How long will it be shut down? Is it damaged? Can it come back quickly? Same with Qatar. They hit their largest liquefied natural gas export facility. It supplies 20% of global LNG supply. That was shut down. How long will that shut down? How long does it take to restart 14 LNG production trains? So what's kind of interesting about this conflict is that the Strait of Hormuz, theoretically, if there was a peace deal, you could kind of resume traffic pretty quickly if there were assurances from the U.S. if something happened, and then the trade resumes and everything's back to normal. But if infrastructure is hit, if a pipeline is hit, if Iraq is taking offline their largest oil field, suddenly things get a bit more complicated. Actual barrels aren't making its way into the market. And if there's damage, how long does that repair take? Are we talking days, weeks, months? There are a lot of unknowns. And as every day that this continues, the risk premium kind of chugs along and gets higher.
And Yvonne, I'd like you to jump in here. You've been looking at the impact that this could potentially have across the African continent, especially as it pertains to higher energy prices, as Stephen was just mentioning there. What has been your focus over the past few days?
So a few things divide the African continent like a surge in the oil price. And the reason for that is because we're primarily exporters and commodities, and we import almost all our refined petroleum needs on the continent. So such a significant increase in the oil price, of course, will benefit our oil exporters, in particular countries such as Nigeria and Angola. Angola in particular, we estimated what a $20 increase in the barrel increase in the oil price could mean. So in the case of Angola, that could improve its current account balance by as much as 3% of GDP. So it's quite significant. However, the majority of African countries are net oil importers. So unfortunately, this is negative for the majority of the continent. Countries like South Africa and Kenya will be hit on the external balances side by as much as 1% of GDP on their current account as a result of such a significant surge in the oil price, assuming, of course, prices remain at these levels. Aside from the trade channel, we're concerned about what it means for inflation. Africa has generally enjoyed this inflationary trend over the past couple of years that's allowed countries to reduce their inflation targets or contributed to that in the case of South Africa. It supported a reduction of interest rates across the board. This is, of course, following that sharp tightening when we had Russia attack Ukraine and grain prices went up. So now, since then, we've seen inflation come down nicely and interest rates start to follow. Unfortunately, such a huge surge in the oil price does imply that this inflationary trend will be halted, and interest rates may also come back onto the table as an option for central banks.
And Yvonne, Stephen, stick with us. We're going to take a quick break. And when we come back, we're going to dig into more about what this could mean for African economies and how long lasting this shock could actually be. We'll be right back. Welcome back. Today, we're looking at the impact of the war in Iran on energy prices. Stephen Stapczynski and Yvonne Mhango are still with me. Yvonne, let's just take South Africa because, of course, we know that the country's been in focus, recently came out with their budget just a few days ago, had talked about turning around the corner on a lot of the past troubles for the economy. Is this going to undo a lot of the work that the SARB and the government has really done to get inflation under control?
So, yes, you raise a good point in that we are at a positive point in terms of the macro turnaround that we're anticipating. The growth is lagging. However, I do think the buffers that have been put in place will help in terms of mitigating the impact of a higher oil price. An example of such a buffer is the primary budget surplus that the government has accumulated over the past 3 years. So it's the first time in several years that we actually have a primary surplus, and that should help in terms of mitigating the impact on the fiscus. On the current account, the upside, our analysis show that the upside of having a free floating currency, as South Africa does, which is a minority on the continent, is that it behaves as a shock absorber. So what you should see is that the demand for imports should compress as the rand weakens on the back of a weaker external position, and that should help mitigate the impact on the external side of the economy.
Interestingly, we heard the DG of the Treasury talk about how potentially commodity exports and gold could potentially also provide some of that buffer for South Africa. Yvonne, when we look at, let's just broaden it back out to the continent and talk about some of the impacts potentially on the bond market. Have we seen any significant shifts, higher yields as a result of the increased escalation in the Middle East across African bond market?
So following the initial strikes at the weekend and on Monday, yes, we did see indeed the spreads between bond yields for African sovereign bonds and US Treasuries widen as we saw risk-off sentiment take off globally. As we move forward, of course, I think what you'll see is investors will become a bit more discerning. I think you'll see when they look at just at their Africa portfolio that the oil exporters that are bond issuers will see their bond yields ease. And the examples of those are the likes of Nigeria, Gabon, the Republic of Congo. In this environment, those countries should benefit on the back of a higher oil price. Where you're going to see more skepticism or concern is in countries that are oil importing.
Stephen, let's bring you back in, because it really seems like the energy sector, the oil, Brent crude is really what to watch here. I've seen a number of forecasts for how high this could potentially go. What are you looking at in terms of the prices for Brent crude and potentially what the next catalyst could be to creep higher, if we are even headed to 100 or higher, as some analysts are pointing out?
I mean, I think anything is possible, right? I think if you asked me last week or 2 weeks ago if we would see an effective shut to the Strait of Hormuz, I would say the likelihood of that is pretty low. But now we're seeing it. So we're in uncharted territories. This has never happened. And so I think there are a few things to watch out for. Yes, with Brent right now, we're around $83, $84 per barrel. So we're not at $100 yet. But there is a chance where if this continues and if certain things happen, we could be our way to $100 or go above $100. One, if there is some major damage to infrastructure. Right now, there have been some refineries shut, some pipelines, I think targeted, but overall oil is still largely pumping. There has been some shutdowns in Iraq, but even when you look at the ship tracking data and satellites, some analysts are saying that Iran is still exporting oil. So oil is still making its way into the market. But if you were to see any major impact in Saudi Arabia's ability to produce, or even Iran or other countries in the region, I think that starts to creep up a bit more. If you start to see another breakdown in the talks, right? I think yesterday the New York Times reported that there were some back channels between Iran and the U.S. for a potential peace deal. You saw Brent and gas prices kind of fall a little bit, but then Brent kind of made up some of those losses. If we now see that there's a total breakdown in discussions, or if rhetoric from Trump changes, you could see prices rise again. And then you also see potentially a bidding up of prices from Asia. Right now, I think Asian customers are somewhat calm, right? Asia is the biggest buyer of this Middle Eastern oil, but yet you're not really getting the sense of panic that you're getting, for example, in the natural gas market. So if you do start to see people fighting over shipments, if you were to have what I would call a price war over deliveries that are on the market and taking up that spare supply, and you see the oil on the water start to shrink, then you could see again prices rise. But what's interesting about the oil market at the moment is we were supposed to enter a year of an oversupply. There's quite a bit of oil available. So with the glut, still there, if there were a peace deal, I think quickly you would see a lot of this deflate.
That's a really good point that you bring up. We went into 2026 talking about oversupply. Yvonne, is that similar to you? Is that sort of what you're focused on, really the price of crude and where it goes next and how that could trickle down to the African economies?
Yes, I think our assumption, if you just look at the fundamentals, is that there's an abundance of supply and that we expected, in the absence of conflict, we expected the oil price to remain flat, if not cool. So a lot depends on the longevity of the conflict and whether indeed the Strait of Hormuz remains shut for an extended period. But the fundamentals outside of war suggest that we should have a cooler energy prices, which would benefit the majority of the continent.
Still quite a bit of unknowns, but we appreciate the two of you joining us this week to break down what we do know at this point in time. Stapczynski and Yvonne Mhango, thank you both so much for joining us this week. And you can, of course, read all of our coverage on the war in Iran across Bloomberg platforms now. Here's some of the other stories we've been following across the region this week. Dangote Cement, Africa's biggest producer of the building material, will spend $1 billion to boost capacity over the next 4 years as infrastructure construction spurs demand. And Nigeria brought the timetable for next year's election forward and announced new rules that appeared to catch the opposition off guard. Presidential and National Assembly elections will be held on January 16th, 2027, roughly a month earlier than was previously scheduled, the Independent National Electoral Commission said. And you can follow these stories across Bloomberg, including the Next Africa newsletter. We'll put a link to that in the show notes. This program was produced by Adrian Bradley and Tiwa Adebayo. Don't forget to follow and review this show wherever you usually get your podcasts. I'm Jennifer Zabasajja. Thanks as always for listening.